Welcome to Dr. Fred Markets. This is not financial advice. The gap between those who understand finance and those who don't is growing every year. Markets, crypto, artificial intelligence, they just require attention. You showed up today. You're on the right side of that gap. Let's make it count. Let's go.
Retirement is now a rigged casino, and your landlord owns the table. Signal 1. U.S. home prices are up about 130% since 2012, but median wages are up barely 50%, and the rent-to-income ratio in big cities now pushes 40% for new leases. Signal 2. Blackstone, KKR, and other private credit and real estate sharks now manage over $2 trillion in alternatives. And a growing slice is literally your rent checks, securitized into neat little products for rich clients. Signal 3. While everyone panics about war headlines and elections, boring REITs and private credit funds quietly vacuum hundreds of billions by lending to landlords at 8 to 12%, while your high-yield savings pays 4.5% if you're lucky. So here's the cliff. Your rent is someone else's bond coupon, your debt is someone else's retirement, and you're stuck eating the late fees. The connection nobody explains. Private credit is the shadow banker of your landlord, and real estate is the collateral that makes it all look safe. Politicians tweet about housing affordability, central banks mumble about inflation, but in the background, funds are doing a simple trade. Borrow cheap from people like you, lend expensive to the people who own everything you need. Let's pull apart the machine. Piece 1. The housing chokehold. When the Fed hiked rates, everyone declared housing dead. Prices dipped a bit, then shrugged and ripped back up. Why? Because supply is frozen. Existing owners sit on 3% mortgages. New construction is a trickle. Meanwhile, demand doesn't go away. People still need a bed and a bathroom. So landlords raise rents, vacancy falls, cash flow goes up. That cash flow becomes collateral, and that collateral becomes the playground for private credit. Piece 2. The private credit pipeline. Private credit funds act like banks without the annoying regulation part. They raise money from pensions, endowments, wealthy investors. Then they lend directly to companies and property owners that banks find too messy or too risky. Numbers. Private credit assets went from around $300 in 2010 to well over $1.6 today. That's a 5x balloon of "we'll lend where banks won't" money. A fat chunk is going into real estate loans, bridge loans, construction loans, landlord refinancings at 8 to 12% interest. Who pays that 8 to 12%? You do, through rent, through fees, through higher prices at every business that borrows from these funds. The yield your landlord promises their lender gets extracted from your monthly bank transfer.
Does what you just heard make you want to dig deeper? Good, because that curiosity is exactly what brought you here, and the second part is going to take it further. Let's go.
Piece 3. Your safe portfolio is feeding this beast. Your 401k target date fund, your diversified income ETF, your pension, they are starved for yield. Government bonds don't pay enough to hit return targets, so they slide more and more money into alternative credit and real asset income strategies. Translation: your retirement money is quietly funding the same private credit and real estate deals that squeeze you on rent and debt today. You are paying interest with one pocket and collecting scraps with the other. Minus management fees, of course. Here's the one thing you learned today. Your rent check is not just disappearing into a landlord's Lambo fund. It is literally underwriting an entire financial ecosystem where your pain gets securitized into someone else's stable yield. So what do? You stop playing purely as the victim. Action 1. Track the pipeline. Look up the top public REITs and listed private credit style funds. No stock tips here, just education. Read their presentations. You'll see exactly what kinds of properties and loans your city is being carved into. Your neighborhood is a bullet point in someone's deck. Know which one. Action 2. Tilt your exposure. Not financial advice, but stop pretending your index fund is the whole world. If 40% of your take-home pay is rent and 0% of your portfolio touches anything that earns from rent or credit spreads, you're on the wrong side of the trade 100% of the time. At minimum, understand how much of your retirement already lives in real estate debt and equity, then choose if you want more, less, or different. Action 3. Attack debt cost aggressively. You will never outinvest 22% credit card interest or 10% personal loans by buying random stocks. The exact same math that makes private credit beautiful for investors makes it hell for you as a borrower. Kill expensive debt first. Every dollar of interest you stop paying is a dividend you pay yourself, tax-free, risk-free. Verdict: the system is not fair, but it is legible. Your rent funds yield, your debt funds yield. Someone is on the receiving end. You either stay the product or you learn enough of the plumbing to move one step closer to the side that collects. This is not financial advice, but it is the truth. If you learned one new mechanism today, subscribe. Tomorrow we dissect another rigged game and how to flip one rule in your favor. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.